Hello traders and welcome back to this channel. My name is Ali Akbar and today we are about to embark on a revolutionary strategy that compares candlestick math blending with traditional candlestick pattern, ultimately leading to simplify and explosive trading success. In this video I'll guide you through various candlestick patterns such as bullish and bearish engulfing, three white soldiers and three black clues, and so much more. Some of these patterns have weird names and complex instructions. Remembering and identifying them on price chart can be a real challenge. That's where candlestick math blending comes into play. Using this simple new technique, we can blend 2, 3 or more candles together, creating a fresh candle with a new body and a new wicks. This unlocks invaluable insight into market movement. Trust me, it is a game changer you absolutely won't want to miss. But before we dive in, make sure to hit that subscribe button and ring the notification bell. This way you will never miss out on powerful trading insight like these. So stay tuned to discover how this blending technique can lead to explosive results in your trading journey. But first, let's talk about the doji's pattern. Alright? Let's jump right in. Before we delve into candlestick math blending, let's go through some well-known candlestick patterns and their formations. Then I'll demonstrate how they align with candlestick blending technique. You will quickly realize how easily you can spot these patterns or these reversal patterns with your own naked eye without the necessity of understanding complex patterns and their complicated instructions. It is a straightforward process that empowered you to enter trade confidently in a matter of seconds. One of the commonly encountered candlestick patterns is the doji, which indicates a state of market indecision. There are 5 distinct single candlestick patterns, with the first being the doji star. The doji star has a cross-like shape where the opening and closing price coincide. Additionally, it features minimal upper and lower shadows. This pattern characterized as low volatility and a sense of uncertainty between buyers and sellers. The high and low prices are typically close to the opening and closing prices. The second one is a long leg doji. A long leg doji also looks like a cross shape. It occurs when the opening and closing prices are very close, which is a sign of market indecision. The long upper and lower shadows representing high volatility and price movement. Traders often see long leg doji as a sign of trend reversal or losing strength. The third doji is dragonfly doji. In dragonfly doji, the open, close, and high prices are at the same level. This pattern signals a strong bullish sentiment, and when it's seen at the bottom of a downtrend, it strongly suggests that the prevailing downtrend is near the end, possibly indicating an impending trend reversal. The fourth one is gravestone doji. In gravestone doji, the open, close, and the low prices are all at the same level. The gravestone doji candlestick pattern is considered as a bearish reversal sign or signal, especially when it appears at the peak of an uptrend. It indicates that the uptrend may be losing momentum or potentially about to reverse. Finally, the last one is 4-price doji. The 4-price doji is characterized by convergence of open, close, high, and low prices are all at the same level. This distinct pattern signifies a profound sense of indecision prevailing in the market. Both buyers and sellers are showing a clear hesitancy to actively participate in trading. In this graph, we notice some important pattern. At first, the price goes up steadily, which we call it an uptrend. But in the middle of this uptrend or upward movement, we see two long leg doji plus a dragonfly doji followed by another one graveyard doji and also a dragonfly doji. So these candles act like a kind of speed bump, causing the uptrend to slow down and eventually change direction. When the price hit the lowest point of the downtrend, of this downtrend, we see another one of these long leg dojis. This suggests a possible shift in the direction, suggesting a new uptrend may begin. It's important to note that this new uptrend continued to climb. We see two big, strong Marabozo type candles which indicate a strong buying activities. This is Marabozo type candles. However, the uptrend is interrupted again here by the reappearance of the long leg doji. This tells us that the market is uncertain and there might be a potential change in trend direction. As you see, after trend reverses, after this long leg doji, the trend reverses going down strongly. To sum it up, when we see a long leg doji during an uptrend, it is like a caution sign telling us things might slow down. And if it shows up at the highest point of an uptrend, like here, or at the lowest point of a downtrend, like here, it could be a signal that the trend might reverse. The MACD indicator here also support the idea of slowing down and signal a potential reversal at the three specific points on the graph. Here you see the trend is slowing down, and here you see that the trend is going down, and you see by the histogram bar that it shows red or a bearish histogram bar. And here, because of this, the trend changes direction and you see the histogram bars shows green. And again, at the top of this uptrend, when we see this long leg doji, the histogram bars again shows red. That means that the trend is going downward. So I can say additionally the histogram bars validate the points we have discussed. In this graph of the USD Canadian pair on an hourly time frame, we noticed two dragonfly doji and one long leg doji. These candles cause the trend to pause and consolidate for a couple of hours before eventually reversing and heading upward. At the peak of this uptrend, here we also spot a long leg doji with extended upper and lower shadow. This leads to collapse of this uptrend, resulting in a strong downtrend reversal. The MACD indicator also, here you see the histogram bar is flat, showing that the trend is consolidating. And then after that, and then you see the trend is going up and the histogram bar shows green above the zero line, and at this location it changes to red or bearish and going down, and you see that here the trend is going downward, and the histogram bars also confirm this. So the MACD indicator further confirmed these two reversals by displaying bullish green histogram bars for an uptrend and bearish red bars for a downtrend. In this episode, we'll be exploring two fascinating candlestick patterns, the hammer and the shooting star. Let's start with the hammer candlestick pattern, a widely recognized pattern among traders. The hammer is a bullish reversal signal typically observed at the end of a downtrend. It's characterized by a small body near the upper part of the candlestick, where the opening and closing price are very close to the top. This is complemented by an extensive lower shadows that at least double the length of the body, often with a negligible or no upper shadows. The hammer signifies that buyers have stepped in after a downtrend, pushing the price up from its lowest point of the session. This action resembles a hammer striking a nail, indicating a potential reversal of the trend toward the upside. The second crucial pattern frequently utilized is the shooting star. It displays a small body with an extensive upper shadow and typically emerge after an uptrend. The open and close price is very close to the bottom of the candlestick. This pattern serves as a bearish reversal signal typically seen at the top of an uptrend. The shooting star demonstrates the sellers have entered the market, surpassing the buyers and promoting a decline in price from its highest point. This suggests a potential shift in trend direction towards the downside. Understanding these patterns can yield valuable insight into market sentiment and offer clues about potential price movement. Hammer and shooting star reversal pattern. This is K-Stock D1 time frame Yahoo Finance. At the beginning, we see the trend consolidating, characterized by the presence of this long leg doji and these two doji stars. During this phase, there is minor fluctuations, but overall the price moves along a straight path. After this consolidation, the trend gained momentum and heading upward. At the peak of this uptrend, we observe a bearish tweezer top reversal pattern, leading to a downtrend reversal. At the bottom of this downtrend, we see a bearish hammer with a strong bullish momentum. This promotes a reversal in a trend, pushing it upward. However, at the high point of this new uptrend, a bullish shooting star appears with significant bearish string. This signals that sellers have entered the market with the intention of driving the price lower. Subsequently, the trend reverses, heading downward all the way. Recognizing these reversal patterns can be beneficial provided you are familiar with the patterns and their implications. By incorporating candlestick math blending or analysis, you can identify these patterns with your own naked eye and make informed trading decisions and jump into the trade. As a skilled trader, it is crucial to validate the trend using other forms of price action and indicators. The bullish engulfing pattern is a widely recognized candlestick pattern used in technical analysis. This pattern occurs after a downtrend signaling a potential bullish reversal in the market. Bullish engulfing pattern consists of two candles. The first candle is typically a small bearish candle, and the second one is a larger bullish candle that completely engulfs the previous candle's body. The bullish engulfing pattern suggests that the buyers have overcome the sellers, indicating a shift in market sentiment from bearish to bullish. It implies potential buying opportunities. If this pattern is seen at the bottom of a downtrend, it suggests an uptrend reversal. The bearish engulfing pattern is also widely used in technical analysis. This pattern occurs after an uptrend and is a strong signal of potential bearish reversal. Bearish engulfing pattern is also consists of two candles. The first candle is typically a small bullish candle followed by a larger bearish candle that completely engulfs the previous candle's body. The bearish engulfing suggests that the sellers have controlled the market, indicating a shift in market sentiment from bullish to bearish. It implies potential selling opportunities. So if this pattern is seen at the top of an uptrend, it suggests a downtrend reversal. Let's have some real examples. Bullish engulfing reversal pattern. This is CL stock focusing on D1 time frame. We spot a powerful bullish engulfing pattern at the bottom of this downtrend right here, which caused a significant shift, propelling the trend reverses its direction, going strongly upward. It is interesting to see how MACD indicators support this reversal. Here you see the MACD line confidently crosses the signal line while going upward, indicating an uptrend. And also the histogram bars shows green. That's another indication of the trend reversal. This signals a wave of eager buyers entering the market, pushing the price higher, as clearly indicated by MACD indicators. Now let's talk about some patterns and formations that might seem a bit difficult due to their complex name and instructions. I'll show you a game-changing technique called Candlestick Math Blending. This method eliminates the need to memorize intricate patterns. Instead, you can easily spot and analyze them with your own naked eye, making it a straightforward to make informed trading decisions. So stick around for that. It's going to be a game changer for your trading strategy. The 3 inside up reversal pattern is a strong bullish pattern that consists of 3 candles. The first one is a long and a strong bearish candle. The second one is a small bullish candle that should be engulfed by the bearish candle and close about the mid half of the previous bearish candle. The third candle is also a bullish candle and should close above the close price of the first candle. Ideally, close above the high of the second candle. This is the 3 inside up reversal pattern. The 3 inside down reversal pattern is a strong bearish pattern that consists of 3 candles. The first one is a strong bullish candle. The second one is a strong bearish candle that should be engulfed by the bullish candle and close about the mid half of the previous bullish candle. The third candle is also a bearish candle that should close below the low price of the first candle, ideally close below the low price of the second candle. This is how the 3 inside down reversal pattern look like. Traders should always take into account additional factors and use various indicators before making any trading decisions. You see the 3 inside up and the 3 inside down reversal patterns are also come with complex name and instructions, making them challenging to remember. However, with Candlestick Math Blending technique, you can quickly identify and recognize these patterns on your own chart. This method eliminates the need to memorize intricate details, ultimately save you time and money. It allows you to make quicker and more informed trading decisions. Let's have some real examples. Bullish abandoned baby reversal pattern. The bullish abandoned baby is a candlestick pattern that signals a potential reversal from a downtrend to an uptrend. It consists of 3 candles. The first candle is a bearish candle, which indicates a downtrend. The second candle is a doji, which gaps down in relation to the first bearish candle. It has a small body indicating that the opening and closing prices are very close to each other. This reflects market indecision, and the third candle is a bullish candle indicating a strong upward move. It opens significantly higher than the close of the previous doji and closes above the high of the first bearish candle. Bullish abandoned baby is considered more reliable when it appears after a prolonged downtrend, signifying a shift in market sentiment from bearish to bullish. Bearish abandoned baby reversal pattern. The bearish abandoned baby is a candlestick pattern that signals a potential reversal from an uptrend to a downtrend. It consists of 3 candles. The first candle is a bullish candle, which indicates an uptrend. The second candle is a doji, which gaps up in relation to the first bullish candle. It has a small body indicating that The opening and closing prices are very close to each other. This reflects market indecision. The third candle is a strong bearish candle indicating a downtrend move. It opens significantly lower than the close of the previous doji and closes below the low of the first bullish candle. The bearish abandon baby is considered more reliable when it appears after a prolonged uptrend, signifying a shift in market sentiment from bullish to bearish. Remember, while the bullish and bearish abandon baby pattern can be a powerful signal, it is important to note that no pattern is foolproof. Traders should always take into account additional factors and use various indicators before making any trading decisions. You see, trading patterns often come with complex name and instructions, making them challenging to remember. However, with candlestick math blending technique, you can quickly identify and recognize these patterns on your chart. For instance, you might notice a bullish or bearish abandon baby indicating a potential trend reversal. This method eliminates the need to memorize intricate details, ultimately saving your time and money. It allows you to make quicker and more informed trading decisions. Let's have some real examples. In this chart, take a look at Tesla stock on a D1 time frame. We notice a bullish abandon baby reversal pattern at the low point of a downtrend. This pattern holds substantial potential for an upswing. Subsequently, the trend gently shifts direction, guided by the interest of buyers who is willing to push the price higher. This shift was further supported by the MACD indicators, where the MACD line, the blue line, crosses the orange line, the signal line, while going upward. It's showing a shift direction from downtrend to uptrend. And here you can see from downtrend and it's hitting uptrend. Simultaneously, the histogram bars shows this positive movement, displaying a series of ascending green bars going upward. So this shows the trend changes its direction from downtrend to an uptrend. Now let's explore the core concept of this video, candlestick math blending. I'll illustrate just how effortlessly you can identify price reversal. So stay tuned. Candlestick pattern has always been complicated and cumbersome to traders due to their complexity. However, with the introduction of candlestick math blending, you are provided with a powerful tool to simplify this process, overcome this complication, and suggest a clear understanding of market dynamics and price movements. Candlestick math and candlestick blending are both identical and referring to the same thing. This method allows us to mathematically combine two, three, or multiple candles together to creating a new candle with a new body and a new wicks that provides valuable insights into market movement. While there are hundreds of books, articles, videos on complicated patterns and formations, many of these patterns have a weird name and complicated instructions that is very hard to remember, and recognize these patterns on the price chart is cumbersome and confusing. Let's imagine for a moment that you must memorize the weird name and instructions of pattern such as doji, hammer, inverted hammer, shooting star, hanging man, bullish and bearish engulfing, tweezer top and tweezer bottom, harami, morning and evening stars, 3 white soldiers and 3 black crews, piercing, dark cloud cover, 3 inside up and 3 inside down, falling and rising 3 method, bullish and bearish abandon baby, upside gap to cruise and downside gap to dove, and so much more. To add a touch of humor, just for fun, I'm adding two to this list myself: the bullish and bearish singing cat and flying chicken reversal pattern. I'm asking you, how many of you remember all these patterns by heart and can spot them on your price chart? Probably none, or not too many. Here I am going to show you candlestick math blending technique that you do not have to memorize these patterns with weird name and complicated instructions by heart. With candlestick math blending, you can spot these patterns with your own naked eye in a matter of seconds and jump into the trade immediately. It is interesting to know that the blending outcome of almost all these famous patterns are nothing but bullish or bearish hammer or bullish or bearish shooting star. Let me show you how. Examining BLDP stock on a daily time frame, I have noticed a distinct sequence of 3 candles at the lowest point of the preceding downtrend. The first one is a bearish candle, and the second and third one are both bullish candle, all with D1 time frame. Following these 3 consecutive candles, the trend shifted direction and started moving upward. Although this particular pattern might be unfamiliar to me, I decided to apply candlestick math blending to find the equivalent in order to potentially uncover insight into why this trend reversal occurred. This analytical approach may provide me with valuable clues about the change in market sentiment and direction. Having this knowledge on hand, I can make well-informed decisions about when and where to initiate my trade. Let me show you how to blend these 3 candles. This is the same BLDP stock and the one time frame, and these are the 3 candles at the bottom of this downtrend. The rule to blend these 3 candles is so easy. We take the open of the first candle, then we take the close of the last candle, and we take the portion between open and close, and then we take the highest and lowest point of these 3 candles, and the equivalent is nothing but a bullish hammer with 3 days time frame. Now if we replace these 3 candles with this strong, powerful bullish hammer at the bottom of this downtrend, that is the reason why the trend reverses heading upward. This is how you blend 2, 3 or more candles to find the equivalent. You can also use the average blending technique. In average blending method, we use the average open, close, high and low prices of these 3 candles, and the equivalent is going to be the average open, close, high and low prices of these 3 candles with D1 time frame. This is your preference which method you are going to use. The first method is much easier since you do not need to calculate the average of these 3 candles. Let's have more examples. This is crude oil stock on a daily time frame, we have identified these three significant entry points for trading. These points occur at the truth of downtrends and a peak of an uptrend. It is worth noting that the patterns observed at these locations do not conform to commonly recognized patterns. Therefore, we have decided to combine these patterns using candlestick math blending. During the initial downward or downtrend, we blend these 6 consecutive candles, resulting in a pattern resembling a bearish hammer, yet exhibiting a strong bullish momentum. The color of these candles is less relevant as the opening and closing prices are in close proximity, with greater emphasis on the overall length. This blending led to a reversal from downtrend to an uptrend. In the second instance, corresponding to the uptrend, we again blended these 5 candles. This time the equivalent resembled a bearish shooting star, indicating significant bearish pressure. Subsequently, the trend shifted downward. The third downtrend location involved blending these 3 candles, producing a pattern defined by a strong bullish hammer. This strong bullish power plays a significant role in driving the trend upward. This approach emphasizes understanding the essence of these blended patterns without the need for memorizing a specific pattern's name or complicated instructions. Let's have another real example. In a realm of daily time frame analysis of crude oil stock, we have pinpointed 3 entry points for trading. These points coincide with the truths of downtrend and the peaks of uptrends. It's worth noting that some of these patterns observed at these locations do not conform to commonly recognized patterns. Therefore, we have decided to blend them using candlestick math blending. In the initial uptrend phase, a bearish shooting star manifested at the top of this uptrend with substantial bearish force, which it means the sellers control the market and willing to push the price lower, resulting in a trend reversal. The second trading entry location is at the bottom of this downtrend. Upon closer observation, we identify this as a bullish engulfing pattern involving 2 candles. Blending these candles yielded a robust bullish hammer with significant upward pressure. The final entry point occurs at the top of an uptrend featuring 3 candles. In the absence of a recognizable pattern, we had to blend them with candlestick math blending, resulting in a strong bearish shooting star with 3 days time frame. This powerful bearish momentum played a crucial role in pushing the trend downward. This approach emphasizes understanding the essence of these blended patterns without the need for memorizing a specific pattern's name or complicated instructions. It enables swift assessment of trend sentiments facilitating timely entry into trades. Let's recap what we have covered so far. This video aimed to elucidate three crucial points. The first one is candlestick pattern and formation explanation. I provided a detailed explanation of several significant candlestick patterns and formations utilized by traders, emphasizing how they can lead to successful trades. I highlighted the overwhelming variety of patterns, many of which have complex names and instructions. Memorizing them all can be both impractical and bothersome. Second, candlestick math blending simplifies pattern. I introduced the concept of candlestick math blending, a technique to combine existing patterns for comparison. I demonstrated how effortlessly one can combine these patterns and identify their equivalents, even with your own naked eye in a matter of seconds. This eliminates the need for memorization. Finally, the third one is outcome tends toward hammer or shooting star. It's worth noting that the ultimate outcome of most of these reversal patterns tends to show up as either a bullish or bearish hammer or a bullish or bearish shooting star. Therefore, when observing any chart for signs of a trend reversal, keep in mind that the result may likely to be one of these four formations. That concludes our discussion. If you find this video helpful, please consider subscribing to receive timely updates on my new content. That's all, folks. If you like this video, thumbs up and subscribe. Thanks for watching. Take care and see you next time.